Today we're digging into, well, a massive paradox, isn't it? How do some people see a financial crash coming, stay calm, and actually get wealthier?
While everyone else is, hitting the panic button, selling low.
Exactly. Chaos for most, but opportunity for a few. What's going on there?
That's really the core question. And our mission today isn't about drumming up fear. It's about looking at, cycles, math. We're diving into sources arguing a major financial reset isn't just a possibility. It's historically probable based on certain indicators.
Okay.
And the goal is to give you a clear strategy, how to see this potential crash not as an end, but as maybe the biggest financial opportunity you'll encounter.
And the timing feels urgent because things look weird right now. The economy's clearly hitting the brakes, right? Inflation's sticky, rates are high, layoffs are happening.
Definitely headwinds there.
But then you look at the stock market and it's flirting with all-time highs. How does that compute?
It doesn't, really. And that disconnect, that gap between market optimism and the reality on the ground, that's often the loudest warning sign. It's this feeling of safety, ironically, that can make things most dangerous. When the basic math feels off, something's got to give eventually.
Okay, let's unpack that disconnect. You mentioned this late cycle illusion. What exactly is that?
It's that phase, you see it almost every boom cycle, where optimism just kind of overrides basic logic. People start genuinely believing that famous, dangerous line, "This time is different."
Ah, yes, the four most expensive words in investing.
Pretty much. And it's happening now against a backdrop of real economic strain. We're talking about what some call the everything bubble.
Everything bubble, meaning?
Stocks, housing, private equity, all those super speculative assets, they all got inflated together by, a decade of almost free money.
Right, near zero interest rates pumped air into everything.
Exactly. And now that era is over.
Yeah.
Businesses that absolutely relied on that cheap money, they're struggling, suffocating, even under higher rates that demand actual profits.
Which many just can't generate.
Correct. And then you look at the individual level, and it's tough. People stretching for houses that are priced way beyond historical affordability norms.
Taking on huge mortgages at much higher rates now, too.
Yeah, 7%, 8% sometimes. And look at the credit card debt, it's exploded. Wages just haven't kept up with costs, so people borrow to survive.
So the market's partying, but the average person is feeling the squeeze. That's the illusion.
That's the core of it.
But hang on, let me push back here. If inflation is still a real problem, say it stays stubbornly high, 4 or 5%, how can we seriously suggest holding cash? Cash is losing value every single day in that scenario, isn't it? That feels almost irresponsible.
That's a totally valid point, and it's probably the trickiest part of this strategy. You're right, holding cash when inflation's high is painful. You feel like you're losing ground. But the strategy isn't about holding cash indefinitely. It's about perspective. That temporary erosion of purchasing power from inflation, it's a calculated risk, a cost you accept. Why?
Because the alternative is worse.
Exactly. Because the potential alternative, losing 30, 40, maybe 50% of your asset value in a sharp crash, is far, far more destructive financially. Volatility and panic can destroy wealth much faster than inflation typically does.
Yeah.
So cash isn't trash in this context. It becomes your tactical weapon, your dry powder.
Okay.
You're just waiting for that moment when quality assets go on a massive panic-driven sale.
Okay, that reframes the cash issue. So if we accept the math feels broken, what are the concrete signs? The hard evidence? The sources point to 4 specific historical clues, right?
Yes, 4 key indicators that have historically signaled peak valuation and trouble ahead.
Let's take the first one, probably the most famous, the Buffett indicator.
Right. Named after Warren Buffett, obviously. It's pretty straightforward conceptually. It compares the total value of the stock market.
All publicly traded stocks.
Yes, their total market capitalization.
Compares that to the country's GDP, its total economic output.
Yeah.
It's asking, is the market's valuation grounded in real economic activity?
And what's it saying now? Well, this is where it gets quite startling. Our analysis shows the ratio is currently sitting at nearly double its long-term historical average.
Double?
Almost double. So think about it. For every dollar of actual economic value being produced, the market is pricing companies at roughly $2. We saw similar peaks, maybe not quite this high, but close, right before the dot-com crash in 2000 and the 2008 financial crisis. When this flashes red, it's basically yelling that prices are detached from fundamentals.
Okay, that's sobering. Clue number 2 sounds counterintuitive. The Fed's trap. People hope Fed rate cuts will ride to the rescue, right?
That's the common narrative, yeah. Don't worry, the Fed will cut rates and everything will be fine. But history tells a very different story about when the Fed actually cuts.
What do you mean?
Well, think about why the Fed cuts rates. It's not usually proactive just to goose the market. They cut rates in reaction to something bad already happening.
Like the economy visibly weakening?
Exactly. Usually it's in response to clear signs of economic damage, rising unemployment, businesses reporting sharply lower profits, credit tightening up. So the rate cut itself isn't the cavalry arriving. It's more like the official announcement that, the recessionary conditions are here and profits are already shrinking.
So the first cut often marks the start of the acknowledged pain, not the end.
Historically, yes. Most major modern recessions actually began around the time the Fed started cutting rates, because by then the underlying damage was significant enough to force their hand.
Wow, okay. That flips the script on rate cuts, so it's not the light at the end of the tunnel.
It's often the signal you're fully in the tunnel.
Got it. Clue number 3 brings us back to something tangible. Unsustainable housing.
Right, and this ties into that everything bubble idea.
Yeah.
If you adjust for inflation, believe it or not, U.S. home prices today are actually higher than they were at the absolute peak of the infamous 2006-2007 housing bubble.
Higher than that peak? Seriously?
Higher. And remember, buyers now are locking in these peak prices with mortgage rates around 7 or 8%, not the 4 or 5% we saw years ago.
That's a huge affordability strain.
Massive. It puts household budgets under incredible pressure. It's mathematically unsustainable for many. Housing is a really critical piece here.
Okay. And the fourth clue, crypto. How does the crypto cycle fit into this broader picture? Seems like a different world sometimes.
It can seem that way, but our analysis suggests crypto acts like a canary in the coal mine for global risk appetite, especially for speculation.
The canary, how so?
Look at its history. Pretty clear 4-year boom and bust cycles, right? Major crashes around 2014, 2018, 2022. It's almost mathematically precise.
Okay.
Crypto is where speculation gets most extreme, most leveraged, most emotional. When that market undergoes its predictable, really brutal corrections, it's often a sign that liquidity is tightening everywhere. It shows a flight from risk that tends to ripple outwards, hitting other highly speculative assets. Think profitless tech stocks, junk bonds, that kind of thing.
So if that 4-year pattern holds,
Then the next major correction, the next big purge of risk across the board, could be slated for around 2026. It's not random. It seems to reflect these broader waves of human behavior tied to easy money cycles. Okay, so if these historical signs are flashing, if the math looks wobbly, we need to shift from just warning signs to actual strategy, opportunity.
right.
And the core principle here, the one the prepared understand, is that during a crash, wealth doesn't just vanish, it transfers. It quietly moves from the impatient, the emotional sellers, those may be forced to sell because they're over-leveraged, to the prepared, the disciplined ones who have cash ready.
Which brings us back to cash as dry powder. You mentioned Warren Buffett earlier. Wasn't his company, Berkshire Hathaway, sitting on a record cash pile recently?
Exactly. Reports in late 2025 showed Berkshire holding one of the largest cash positions in history.
Yeah.
I think it was something close to half its total assets in cash or equivalents.
Most people would say that's terrible asset allocation in a rising market, leaving money on the sidelines.
From a conventional view, maybe?
Right.
But from a strategic long-term view, it wasn't just hoarding, it was positioning. It was building ammunition. Because cash, when everyone else is panicking and forced to sell perfectly good assets at knockdown prices, cash becomes incredibly powerful. It's the ultimate weapon in a fire sale.
So you can buy great companies, great real estate, whatever's on your list, at huge discounts.
Precisely. When quality assets drop 40, 50% purely due to market fear, not because the underlying business is broken, cash holders can step in and buy. They aren't forced sellers. They become opportunistic buyers.
So dry powder isn't just about safety. It's about having the capital ready to pounce. It's an offensive strategy, not just defensive.
That's a great way to put it. It gives the prepared investor control. They get to dictate terms when everyone else is scrambling. This is fundamentally why the rich often get richer in these scenarios. They're positioned to capture value when fear dominates.
Okay, but acting during a crash is tough. Things move fast, fear is overwhelming, you need a plan before it happens, right? Otherwise, emotion just takes over.
Absolutely critical. The window for action is usually quite small. Panic sets in fast, but the rebound can also be surprisingly quick sometimes. You need an operational plan.
So the sources outline a kind of step-by-step approach.
Yes, a 5-step framework to prepare and act.
Okay, step 1.
Step 1, build your dry powder. This goes back to our cash discussion. You need enough cash or very safe, short-term investments that won't lose value in a downturn.
How much is enough? Does it have to be 50% like Buffett?
No, not necessarily. Even having, say, 30% of your investable assets in this dry powder state can give you significant firepower, enough to make a real difference when opportunities appear.
Okay, got the powder. Step 2.
Step 2. Make your list now. This is maybe the most important preparation step. Don't wait for the crash to figure out what you want to buy. Identify high-quality assets beforehand. What makes a company great? Strong profits, low debt, a dominant position in its industry, good management. These are the things you look for.
So you have a shopping list ready when the sale starts.
Exactly. You're buying quality on discount, not just chasing whatever fell the most. Have that list of specific companies, ETFs, maybe even sectors you believe in long-term. Make sense?
Step 3.
Step 3. Be patient. Buy the fear. This is about execution and mindset. First, patience. Don't try to time the absolute bottom pick. It's impossible. Nobody does it consistently. The goal isn't perfection. It's acting decisively when fear is peaking, when headlines are terrible, when everyone else is selling or frozen.
Like buying big tech in early 2009, or even Bitcoin in the March 2020 COVID panic.
Perfect examples. Those are moments of maximum fear. Buying then required courage, but it led to incredible long-term gains.
Yeah.
You buy when there's figurative blood in the streets.
Okay, easier said than done, but crucial. Step 4.
Step 4. Diversify your bets. This is risk management 101, but it's even more critical during a crash. Don't go all in on one single stock or one sector or one type of asset.
Because you could be wrong about that one thing.
Precisely. Even great companies can stumble unexpectedly. Spread your dry powder across different quality assets. Maybe some stocks, maybe some bonds or commodities if appropriate, maybe some real estate exposure, even crypto. If, and this is a big if, you truly understand the technology and the risks involved. Diversification protects you from ruin if one bet goes spectacularly wrong.
Okay, diversification is key. And the final step sounds like the hardest.
Step 5. Master your mindset. Absolutely the toughest. This is all psychology.
How do you actually click buy when your portfolio might be down 30, 40, 50% and every news channel is predicting Armageddon?
You have to pre-commit. You have to make the decision now, in the calm light of day, that you will follow your plan. It means trusting the logic of Step 2, your list of quality assets, and overriding the primal fear you'll feel in the moment. Remember, you're not buying the falling price. You're buying the underlying value that fear has temporarily obscured.
So discipline trumps instinct.
It has to. The wealthy prepare their mindset long before they deploy their capital. It's about emotional control under extreme pressure. So let's assume this reset happens.
Right.
What does it look like? Maybe major stock indexes drop 30–40%. Maybe housing prices finally crack under the weight of high rates. Banks probably get more cautious with lending. It sounds like chaos, and it will feel like chaos. But underneath the noise, it's like an economic reset, a forest fire, like we discussed. It clears out the weak players, the excessive debt.
And leaves fertile ground for new growth.
Exactly. It creates bargains for those who are prepared.
You mentioned Buffett again. There's that famous American Express example from 2008, right?
A classic case study.
Yeah.
Amex stock got absolutely hammered, lost something like over 70% of its value, looked like it might be going under during the peak financial panic.
People thought travel and spending would just collapse forever.
Right. But Buffett stepped in, invested hundreds of millions near the bottom. Why? Because he looked past the panic and saw a fundamentally great, durable business franchise.
And that bet made billions eventually.
Billions. Because he understood the core rule. Great assets, great businesses with strong fundamentals, they almost always recover. Bad assets, hyped up companies with no real foundation, they disappear.
So the crucial skill is knowing the difference before the crash hits.
That's the homework. That's step 2, making your list based on quality. So when this financial reset button gets pushed, as the sources suggest it might, you really face a fundamental choice.
Panic or prepare.
Basically, join the herd, sell low, lock in your losses, or see the crash for what it is. A temporary, albeit painful, repricing. A chance to acquire fantastic assets at bargain prices. This is why the prepared often emerge stronger. They understand that durable value outlasts temporary fear. #outrag_outro.
Okay, so the core message seems crystal clear. Preparation is the path to potentially building wealth through chaos. Panic is the path to poverty. And that preparation isn't just about money, it starts now. Building that cash reserve, doing the homework to make your quality asset list, and mentally steeling yourself to act when the time comes.
Exactly. Discipline starts today, not when the market's falling apart. So maybe the final thought to leave everyone with today builds directly on that American Express rule. When the storm does hit, the prepared will be acting decisively, buying quality. The question for you, the listener, to really mull over is, what specific objective criteria are you using right now to differentiate a truly great asset? Solid profits, manageable debt, strong market position from just a currently popular or hyped up one.
So you know exactly what to look for when everything goes on sale.
Precisely. Get that framework solid now, so you're ready to recognize real value when fear makes it cheap.